Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 stocks to consider buying on the relatively long-term dip for huge upside, especially as the market's hitting brand new highs after the Fed officially cut interest rates on Wednesday. And those 3 stocks are Lululemon, Paycom, and Adobe. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these 3 stocks, which are Lululemon, Paycom, and Adobe, I just want to quickly go over where the market stands and possibly what to expect in the coming days and weeks. So as I record this in mid/early afternoon on Thursday, the NASDAQ was up about 2.8%, with the S&P 500 up about 1.8% to brand new all-time highs for the benchmark. And this is after the Fed officially started its easing cycle midweek with a 0.5 percentage point rate cut, so a 50 basis point rate cut. The S&P 500 is now up over 20% in 2024 and up over 45% in the last 2 years to trade at brand new all-time highs. So we've seen now the big jump on Thursday afternoon to new all-time highs. That said, in the near term, it's possible we do experience more volatility. There could be more pressure from big money managers and traders alike to take some profits, since the back half of September is notoriously rough as part of what's already a weak month for the year. And then October proves to be a very rough month historically during election years. So the coming 6 weeks heading into the unknowns of the election could see some more choppiness and volatility. And that doesn't mean that the bull case for the market is out the window, because we now are in an easing cycle. So the Fed started with a 50 basis point cut. And if we look at the overall earnings outlook for the S&P 500, we're still calling for impressive growth. So the most recent Zacks data is calling for 3.8% growth in Q2, 10.5% growth in Q4 for the overall S&P 500 before soaring in 2025 and 2026. And it's worth noting that tech, which is driving the market, tech and finance sector are the only 2 of the 16 Zacks sectors that have seen their Q3 estimates improve since the quarter got underway. So that's actually a positive sign that those are trending in the right direction, and tech is the one driving the market in the long run as well. So with that said, though, don't be shocked if you see some more selling and volatility in the near term amid some profit taking. The CNN Fear and Greed Index, which is kind of a contrarian indicator, is back up from fear last week to now greed, as everyone's jumping back into the market after the Fed finally cut rates. And we could get a little bit overheated in terms of RSI levels, with the S&P 500 now trending back up to that 70 threshold, which would be considered overbought as we're at new all-time highs. So that's kind of the near-term case, that we could have some more choppiness and volatility, especially, as I said, September and October being possibly rough periods historically, and especially heading into the unknowns of the election period. So with that in mind, though, the 3 stocks we're looking at today are sitting way below their all-time highs. And maybe Wall Street starts to look for some beaten down stocks to consider buying in the back half of 2024, with the benchmark now at new all-time highs and a lot of tech names at brand new all-time highs as well. So with that in mind, the first stock of the 3 we're looking at today is Lululemon, which trades on the ticker LULU. The company really did change the fashion industry and spurred an entire new way that people dress, fueling Nike and many other copycat athleisure brands that are now impacting the company in a significant way, at least the stock. The stock has now tumbled in 2024. In fact, it's one of the worst performing S&P 500 stocks. It's down 45% year to date as I record this. The fall comes as the firm offered slightly lower than projected guidance. Many are also worried that the fickle world of fashion could see that its days are numbered after its massive growth over the last year. It's also getting walled in by 2 different types of competitors, those like higher end brands that are competing directly against Lululemon, which are Alo and Viore, which are operating kind of in the same exact ballpark that Lululemon dominated, which was that high-end athleisure brand, and they're now trying to kind of take some of that market share. And then there's also tons of like online-only lower-end brands that are eating up some of their market share as well. So that's kind of the big case for why there's some more nerves around Lululemon at the moment, and it's just kind of hard to stay at the top of your game in the world of fashion when we know that trends kind of come and go. So that's the bear case for Lululemon and why it's down over 45% so far this year. And they've seen their estimates trend slightly in the wrong direction, and they're slowing their top and bottom line growth from what was massive growth over the last few years. So that's kind of why, as I said, they're down so much. But overall, their brand is still really strong. They still sell a lot of different things. They're not just an athleisure brand. They're not just selling leggings. They're more diversified than ever before. And if we look just at the growth they did in 2023, they posted 19% sales growth. This came after 30% growth in 2022 and 42% growth in 2021. So that's just the kind of growth they're coming off of, which was never going to be able to be held up. That was kind of that post-pandemic boom where everyone was spending on everything and kind of just spending on, as I said, Lululemon was a big beneficiary of that. And we're never going to be able to do 20%, 30%, 42% sales growth for the long haul. They also posted 27% adjusted earnings growth in 2023 after 30% growth in 2022. So once again, the bottom line was going to be really difficult to compete against that kind of growth. Most recently, the company topped our estimates at the end of August and provided slightly downbeat guidance, with its 2025 consensus estimate down around 4% over the last several months, and its 2024 estimates down around 2%. So nothing crazy there, even though its overall earnings have trended in the wrong direction over the last few months. If we look at where they were this time last year for both 2024 and 2025, they're still slightly above those levels. So they're coming off of the peaks, but they're still, it's not like they've just completely fallen off a cliff like the stock has. So that kind of gives you this longer term opportunity to possibly buy the beaten down stock. So we're still calling for about 9% revenue growth in 2024 and another 8% revenue growth next year to go from $9.6 billion in 2023 all the way up to $11.3 billion in 2025. And then we're calling for 10% growth on the bottom line and then another 8% growth next year. And as I said, this is on top of those impressive double-digit stretches of growth for both the revenue and adjusted earnings. The company is still on track to deliver what it's called its Power of Three growth plan for doubling the business from 2021 to 2026 from $6.25 billion to $12.5 billion by 2026. And the key pillars of that are doubling their men's business, doubling their e-commerce business, and quadrupling their net international revenue from 2021. So they said their most recent quarter that they're still on track to do that. So that's really impressive. And might be, as I said, another reason why you might want to get in on the stock that's been crushed so far. Its operating margins are still at around 20%, which is almost unmatched in the non-luxury apparel business. And its sales productivity, which is measured per square foot, may fall short of the likes of Apple and Tiffany, but it still by far exceeds its retail pairs in that price per square foot in terms of retail square footage. It's currently landing a number 3 hold, as Zach's ranked number 3 hold, and it's down 45% year to date after hitting new highs right at the end of 2023. Though in a sign of sort of positivity for the company, its CEO recently paid $1 million on September 3rd for 4,000 shares at an average price of $260 a share. So that's a big sign of kind of that he's bullish on his stock. It's been beaten down so much. He says, I'm taking my own money and buying shares of Lululemon because I think they're at a discount. It does appear to be finding some support near its pre-COVID highs. The stock is also still up 540% in the past 10 years, blowing away the S&P 500, which is up around 200%. And it's still up 45% in the last 5 years, despite that tumble. It's now back above its 50-day moving average, and it's still trading at some of its most oversold RSI levels over the last 15 years. And as I said, it's trying to find some support at its pre-COVID highs at the moment. So that's kind of the technical standpoint. And then if we look at a valuation standpoint, it's trading at a 75% discount to its highs at just 18.4 times forward earnings, which is right near its recent decade-long lows. This is also a 35% discount to its median and a discount to the S&P 500, and it's trading nearly 30% below Nike, even though it's crushed the stock over the last 10 years, that being Nike. It also boasts a really stellar balance sheet. It has no debt, $1.6 billion in cash and equivalents, nearly $7 billion in total assets versus just $2.7 billion in liabilities. And its board of directors earlier this year authorized a $1 billion share repurchase program. So with all this in mind, it might be worth taking a chance on beating down Lululemon stock, who's one of the worst performing S&P 500 companies so far this year, down around 45%, even though the S&P 500, as I record this on Thursday, is at brand new all-time highs. And now we're going to move on to another S&P 500 name, and that is Paycom Software, which trades on the ticker PAYC. Paycom is a cloud-based human capital management software firm that boasts it is one HR and payroll solution for managing employees from recruitment to retirement. So it launched back in the late 1990s as one of the first web-based HR and payroll technology companies. And it's slowly, the Paycom and others have slowly kind of transformed the way that companies operate their HR back-end solutions. I'm sure wherever you work, you know that you have like a digital solution for all of these things that used to be managed far differently. So that's Paycom's business. They're still in that business. Some of their options are payroll, talent acquisition, talent management, HR management, time and labor management, all of those various things in the broader world of HR. Its offerings also, though, become pretty much embedded and essential within companies, and few then want to stop using their offering unless they're going to a direct competitor. And this is making companies' lives from small businesses to large enterprises much easier, and as I said, kind of essential to their business going forward. Its growth is also really impressive. The company did 23% revenue growth in 2023 after 30% growth in 2022. 26% growth in 2021, 14% growth in 2020, 30% growth the year before that. So impressive double-digit growth for Paycom, yet the stock has tumbled since it got hit alongside that big growth sell-off in late 2021. And then it fell after a few rough quarters in 2023, including downbeat guidance last fall. So it has not recovered anywhere near like a lot of these former kind of growth at all cost businesses have after that big downturn in 2022. That said, though, it might now be kind of a time to consider looking at Paycom. So its earnings estimates have kind of fallen off a cliff, as I said, in 2023, but they are leveling off and trending slightly higher in the right direction. Recently, it lands a Zacks rank number 3 hold, and it does boast a pretty strong history of earnings beats. And if we look over the last several months, its 2024 estimates up about 1.5%, and its 2025 estimates up 2%. And obviously, that's coming off these lows that have caused the stock to plummet over the last few years. And overall, we're calling for 10% revenue growth this year and then 11% revenue growth next year. And on the bottom line, we're calling for slightly higher earnings in 2024, about 1% earnings growth, and then 12% earnings growth next year. So getting back in the right direction on the bottom line in 2025. And obviously, this is a slowdown compared to what the company had been doing before on the top line. We're calling for, as I said, 10 and 11% growth this year and next year. That's versus 23, 30, 25% growth several years before that. That said, though, they are transitioning the company to be more of a stable company, not that growth at all costs anymore. So last year it rolled out its dividend, which is yielding about 0.9% at the moment. They said at the time that after 25 years of consistent execution with a focus on rapid organic growth and expanding profitability, they're pleased to finally add a new dimension to their capital allocation strategy. So they signaled to Wall Street that they're pivoting to not be growth at all costs and trying to return value to shareholders in another way, as I said, with a dividend. The stock is up still 900% over the last 10 years, blowing away tech's 290% run, yet it's down 20% in the last 5 years now, trading almost 70% below its 2021 peaks. It's currently back above its 50-day moving average and as I record this, it's trying to break above its 200-day moving average alongside that bigger market jump on Thursday afternoon. It also, if we're looking longer term, it recently moved above its 21-week moving average. And if it continues its surge in the near term, it could finally climb back above that 50-week moving average, which could be a really good buying opportunity if you're a longer term investor to get back above these longer term moving averages. It's currently trading 84% below its highs in terms of valuation at just 24.4 times forward 12-month earnings, which is also a discount to the tech sector, and 65% below its own median over the stretch. So the stock's been hit really hard, and it's now trading at a far more reasonable valuation. It's focused on returning value to shareholders in other ways, and we can see that its growth is supposed to return on the bottom line next year. So that's kind of the bull case for why you might want to consider buying Paycom, which is still trading 70% below its all-time highs, even though the S&P 500 is now at brand new records, and it's up 45% or more in the last 2 years alone. Now we're going to close out with Adobe, which trades in the ticker ADBE, and it trades 18% below its 52-week highs and roughly 24% below its all-time highs from 2021. So it's still not recovered from those levels as well. And this is a positive sign if you're a longer-term investor who's considering looking for some of these beaten down big tech names that have not been able to ride the big tech jump in 2024. Investors are worried about slowing top-line growth, and they're worried also about the ability that the lack of its ability to finish a big deal that was supposed to happen, and it was supposed to buy a company called Figma. That acquisition got scrapped because of regulatory headwinds. Now the Wall Street's a little worried that they're going to not know what to do with their cash and try to diversify amid all of these heightened AI concerns. And that's kind of the bigger elephant in the room at the moment, is their growing concerns that its creative software is not going to be able to compete long term with all of these features from companies like OpenAI that allow users to generate creative content with almost no skills involved at all. There's other companies in that business as well, Canva and others, that are able to kind of just have these AI programs that allow anyone to create these pretty high-end creative content generations, videos, images like that. That said, though, Adobe is diving into its own AI efforts, and it's certainly not behind the eight ball there. It has a lot of its own ability to put AI directly into all of its various creative offerings, and its business will still attract a lot of people in lots of industries who want to actually create their own content, and we can prove this out with the numbers looking ahead. So the company topped our Q3 fiscal 2024 earnings per share estimates on September 12th. Still, the stock fell on what some are calling, quote, weak guidance, but Adobe traditionally provides conservative guidance, which is a positive sign. And if we actually look at the estimates are trending higher for 2024 and 2025. So its third quarter revenue as well jumped about 11% year over year as the company lifted its prices on some of its offerings to reflect some of those new AI capabilities. It's able to now offer layering in its Creative Cloud products, or it's offering these various AI efforts in these various Creative Cloud products, including what it's calling its marquee Firefly tool, which is able to take text prompts from users to create AI-generated art. Users can then also export and share the final product. It's one of the ways in which Adobe is trying to differentiate itself, in that it's using its existing stock of rights secured images to train its AI models, leading to maybe less legal risk down the road. I mean, some of these businesses don't really even know what to do with their AI stuff at this point, because it's just pulling things from all over the internet, and there could be lots of lawsuits going forward. So maybe the fact that Adobe didn't rush into all of this, and some of these more like brand new things that are trying to generate all these images might come back to prove to be huge legal headwinds, with people just kind of generating random art that they don't even really know how it's working or anything like that. Adobe is able to kind of have the legal backing to do more of these efforts on the AI front. So overall, yeah, it's still operating really industry-leading creative software. This is used for everywhere from Hollywood studios to college students in offices, Photoshop, Premiere, Illustrator, Lightroom, all of those. They also have a traditional, more like e-signature PDF business as well. So they're still that must-have creative software. They're operating it on a subscription basis, various pricing levels and bundles, and that's all really transformed Adobe into a really impressive, steady revenue and earnings generator. We're calling for another roughly 11% revenue growth in 2024 and 2025 to go from about $19.4 billion in 2023 all the way up to nearly $24 billion in 2025. And then on the bottom line, we're calling for another 14% adjusted earnings growth this year, and then 13% adjusted earnings growth next year. And the growth on the top line would really help see it match 2023 and 2022. So despite all these worries about AI eating its lunch and all these other services, the company is still going to do another 11% growth this year and next, which is the same exact growth it did in 2023 and 2022. Which is a slowdown, though, I will say, from 2021 and 2020, but nothing significant that it hasn't already been hit for in terms of its stock price. So it's down 18% from its early February highs and still trading 24% below its peaks, yet it's still up 665% in the last 10 years, blowing away tech, so easily doubling tech, which is up around 300%. It's also still up 88%, so roughly 90% in the last 5 years. Yet it's down around 2% in the last year. As we record this, it's trying to break back above its 52-week low. So it's kind of hit this current level several times over the last year, and it's finding support there once again. And if we look at a longer term technical chart, it's trying to find support right at its 21-month. So it's a really long-term 21-month moving average. And its 21-month trend line actually just recently climbed back above its 50-month moving average. So that's kind of that golden cross we're looking for, where the shorter dated moving average moves above the longer dated trend line. And then in terms of valuation, it's trading at a 52% discount to its 10-year highs and nearly 20% below its median at 31.2 times forward 12-month earnings. So overall, Adobe at the moment seems like if you're a longer-term investor, buying it about 25% below its all-time highs, its valuation's improving, and its top and bottom line are still growing, and it's showing that even with all these new AI efforts, its ability to get into the AI game at a much higher level is going to help it compete with the clients that really matter long-term, at least in the next several years, which is all we can really look ahead to. But overall, Adobe seems to be worth taking a look at, along with Paycom and Lululemon. As the market hits brand new all-time highs, these stocks still have a lot of upside before they get back to their previous all-time highs. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.